Hey, I'm Al, I'm the founder of Simply Wall Street, and today I'm going to teach you absolutely everything you need to know about dividend investing. Now, at the end of this video, I'm going to show you a technique for making decisions on dividend stocks that you've probably not heard of before, but one that I think will really change how you think about what a good dividend company looks like. Now, as you might be aware, there's a hotly contested debate online about dividend versus growth stocks. And whilst we'll touch on some of the points that are in that debate, I'm going to try to give you a different angle on it that kind of doesn't put the two at odds that they've always been. Unfortunately today, I was hoping we would go sailing together, but there's no wind. So we got the sails set up, or at least got the jib on, and the wind died. So what we're going to have to do is go for a quick motor. Maybe we'll go for a motor around Scotland Island. Today we're going to go through the 3 types of dividend stocks that you can find. We're going to go through how to analyze them, so like what to look for from a fundamental perspective. We're going to then look at how to screen for them, right? So we look for how we analyze, then we're going to look at how do we screen. And when we screen, we're going to actually look at the 3 types, those groups that I just said. And then we're going to talk about making decisions on them, right? Separate thing again, like making a good quality decision. And then finally, we're going to look at managing a dividend portfolio and some techniques there that I think are really powerful. It's just, buying is only the start. Now let's, seeing as there's no wind, we better start the engine. The engine's warm, so it should be easy. Told you it'd be easy. Now everything that I'm going to run through with you today should be actionable. And so there should be nothing that we talk about. Ugh, that's so stinky. And with that in mind, just grab a cup of tea and let's go. All right, let's try getting in reverse first. Okay, that's probably enough reversing. Okay, so the place I'd like to start, and I think the crux of what a lot of people misunderstand about dividend investing and why they get burnt so easily, is that it is best to think of dividend investing exactly the same as any other type of investing, okay? And you're gonna be like, what are you talking about? Well, dividend and growth investing, they're different things. And we're gonna go through that today, and we're gonna see why actually they're not different. So what is different though, and what is important, is that the investor gets to choose how much of the company's profits go to them versus go back to the company. And in my opinion, that's a much better way of thinking about it. Companies pay dividends out of their retained earnings, the money they've actually made, or money they made in the past and maybe they've kept it in the bank. Ideally, it's out of the money they're making. And so in a growth company, that money is being reinvested into whatever the company it is, does that's growing, further growing the business. And that is basically the stock market, that in its simplest form is a compounding machine. And that's why people look at dividends often and think, why are you taking money out? If the company can reinvest it and grow, just let them do that. And this is what a lot of people don't get. It's absolutely fine for investors to want to take some of the profits, and effectively the investor is deciding what to do with it, where to reinvest it. And that's fine. So that's a choice. And so for some companies, the great thing is they allow you to do that. They do pay out dividends at a level where you can do it, and you can reinvest them back in the company if you want, or you can use them to live off. Another way to think of this would be that by choosing to take those profits as a dividend, you're actually removing some of the execution risk from the company. And I'm sure you know about companies where the execution hasn't gone well, where they've said we're going to grow like this, turns out it doesn't work, and that capital is burned. And I think that's the important part to understand about dividend investing, is you're just choosing to say, no thanks, I'll take that capital out and I'll do whatever I want with it. So you're kind of removing execution risk, or a portion of execution risk. You know, we're going to see it's not either or from your investment. Now imagine in some countries combining a $1 million plus dividend portfolio with some of the tax-free schemes that you have, and you can get something that's, as you can imagine, incredibly powerful. And that's why people get so excited about building these dividend portfolios, and what I'm going to show you today, how to exactly do that. To give you an example, in the UK, you have an ISA. An ISA is a tax-free investment account, and you can contribute now up to £20,000 a year. It doesn't sound like much, but if you're contributing over many years, that can really, really add up. And the income from that would be tax-free. And so, again, just imagine once your dividends start to approach an income, which you can get there, that just becomes incredibly powerful. Likewise, in Australia, we have something called franking or dividend imputation. That doesn't really change anything I say in this video about how to choose which companies, how to make decisions. It's just a nice tax benefit, especially if you're not, on a high income, and you can really make the most of those franking credits. Okay, so let's talk about those three different types of companies. The first would be the high yielders. The high yielders, you could call them the yield traps, right? I'm going to use the phrase, but we're going to look at it. And we're definitely going to later on find a lot of yield traps. There's a lot out there. But these are the high yielders. And when I talk about high yielders, I'm talking about these companies paying, 5% plus. Now, again, there are examples of good quality companies here, so I'm not trying to rule these all out, I'm just trying to group them. But these high yielders really broadly have something in common, and that's that they're often companies that are quite mature, they're not growing a lot, and in these instances, you really are swapping growth for that regular payment, and that reflects in the valuations. And these are exactly the same companies which you might have seen online. It would be called a dividend aristocrat or something along those lines. So what that could mean is these companies, maybe they've been paying dividends for 50 years or 70 years or whatever, and they've been increasing it every single year. And you can't fault the actual dividend payments part of the company. Like the dividend payments part of those companies is rock solid. That is not where the issue is. The issue is, generally speaking, not always, but generally speaking, those companies don't perform in terms of their capital appreciation, and so you well and truly are swapping the capital gain for your dividend payments. The next type of dividend company would be, I'm going to call them the sort of moderate yielders. And how these companies usually work is they're usually paying a sub 4% yield. Again, I'm generalizing here, but sub 4%, could be between 1.5 to 4%. But these companies are growing, hopefully growing at least. And so they're growing and they're paying a dividend. And so you're getting, I would say in this instance, a little bit of both. You are getting growth, you're hopefully getting a high quality business that can reinvest and can grow. But those businesses sometimes are just so profitable or such good quality, cash flow generating businesses, they can afford to do both. They can grow and they can pay a dividend. And the last type of company would be what I'm going to call the low dividend payers, or these companies that they pay a dividend, but it's so small, typically sub 1%, that it's almost negligible and almost meaningless. Actually, in simply Wall Street, these companies don't even register. And examples of a company like this could be an Apple or a Microsoft, who both pay dividends, but the yield is small. And it's kind of best to think of these companies almost not as dividend payers, right? They're really just, again, they're good quality businesses and they just happen to pay a very small dividend. It's a much easier way to think about it. And you'd have to own a vast amount of them for that yield to be at all meaningful to you. And here's something that a lot of people just don't get when they're thinking about the yields of these different, those three types of companies that I mentioned. And that is, they're forgetting the valuation. Let me give you an example. So a super high yielding company, it's actually often not that it's just paying a huge dividend. It's often paying a dividend, yes, a high portion of its profits as a dividend, but because that company often is mature and low growth, maybe doesn't have many prospects, the valuation of that company is also typically low. It's probably got a low PE ratio. And so if you think about that, the dividend yield is calculated as the dividend payments out of the share price or the market cap. And so it's not surprising that those companies end up having very high yields naturally, because actually their valuations are very low. And the counter to that, again, would be on the opposite end of the spectrum, a company that's growing really well and one that's valued highly. They also are paying a dividend, usually quite a decent portion of their earnings out, but because they're valued so highly, that yield is actually quite low. Investors value their earnings maybe at a high PE ratio, and it's just it's difficult for them then to compare on that yield basis. And so what this means is that the very best companies, the best dividend paying companies, are not the ones, generally speaking, that are paying these crazy, 7, 10% yields. They're the ones that are just fundamentally great quality businesses that are growing really well. And I think that's the most important lens. And so those are the ones that if you can find them, that's what will create an absolute super powerful dividend portfolio. You might be thinking, Al, how am I going to build a great dividend portfolio if the yield is only 2%? That's just not going to work. And you're right. It would take a very long time if you only had that 2% yield to build up a monster or an absolute killer dividend portfolio. What people are missing here is that depending on the type of companies you go for, and let's assume you're going for that type 2, the one that's growing and has a dividend payment, is that those companies hopefully are going to grow. So your initial investment will grow, and with it will grow the dividends. And so after a while, that what might have started off as a 2% yield could actually start to look like an 8 or 10% yield. But that is happening because the company is growing and the market cap of the company is growing. If you think about it for a second, it would be very strange for a company to just keep increasing its dividend payments over time, but not have the corresponding value of an increase in market cap. It would, after time, it wouldn't be able to sustain it. And this leads me to something that you'll probably read online, which is the yield on cost fallacy. A lot of dividend investors will get very excited about yield on cost, and yield on cost is a great metric. There's nothing wrong with the metric, it's powerful. But they'll get excited because they'll say, oh, but based on my yield on cost, I'm at a 13% yield. And what they're missing is that you could achieve exactly the same yield on cost if you bought a good quality company that increased in value and then used that increase in value to go and buy the very same company. So it's better to think about it that, yes, yield on cost is powerful, but yield on cost only really happens when you invest in good quality growing companies where the company is growing and the dividend is growing. Okay, cool. So before we jump on the laptop and actually look at some of these companies, I just want to say that there's different types of dividend investors. I'm not really trying to advocate for one or the other. I would say that even if you're going down the high yield route, just be aware that you are basically swapping growth for yield, and just accept that, I guess. And even a high yielding company, you still really want growth prospects, and that's where this thing I'm going to show at the end will tie in. So it depends on the life stage of where people are at, what they're looking for, and as I said, some people really want that guaranteed income, and I think as long as you're not losing a ton of capital value, I think there's a lot of potential there. It's very interesting, and great news is I'm going to show you how to do both. Now, before we go and start screening for those 3 different type of dividend companies, I just want to touch on some of the analysis that's behind that. And what the best place to do that is actually our company report. So we're just going to run through a couple of key sections in this report. We're going to contrast a couple of different companies, get an understanding. So then we're all on the same page with what analysis is being done, and that makes it really easy to understand how to screen for them. The place I'm actually going to start is within the overview. So you don't get to it on this side menu, it's within the overview. So if I just scroll down, it's actually just beneath the price chart, and it's this section here, shareholder returns. If I click full shareholder returns, I can now see over the last 5 years how the company has done compared to the industry that it's in and compared to the market. And for a company like this, for AT&T, you can see that well and truly this stock has not moved anywhere in 5 years. It's actually only up, based on price, 1.5%, effectively flat. You could have just had your money sitting in a bank account without any interest. Well, at the same time, the market's up 80%. But here's where it gets interesting. If I toggle here, include dividend returns, you can actually see that when I account for dividends on AT&T, actually those dividend payments have been so substantial that you actually be up 80% just with the dividend payments alone. And if you look at the market, a lot of companies in the S&P aren't paying a dividend, so the difference between the total return and the dividend and the return without the dividend is sort of plus 15%. It's not as different. But this is where it's so obvious that for a company like this, investors have well and truly swapped their capital gain for dividend. And they've really lost out on that 80%. So they're up, sure, but they've really just swapped out capital gain for dividend. And as long as they, maybe that isn't what they intended. Now, the next section we're going to look at is, of course, the dividend section, which we can get to here. And by the way, of course, I'm on my laptop, but you can do this on a mobile phone. It's exactly the same on mobile and on desktop for Simply Wall Street. So now we're in the dividend section. This section does also include buybacks. We'll look at that in a bit. But just some of the key metrics that we're gonna pull out here. So we got the dividend yield, but the one that's really interesting is also the future dividend yield. How are we getting to this future dividend yield? If I go down to this chart here, everything up to this point here is all historical, right? This is all historical data, but then going forward, you can see analyst forecasts. The analysts that cover the company also forecast what they think the company is going to pay in dividends, and so we can actually forecast that out, typically around 3 years, and we can see, well, what do they think the payments are going to be? And I'll show you in the portfolio later. That's a much better way of saying what the yield is, because the historical yield is not always representative of the future yield. And just pulling apart this chart a bit more, the line in purple is the annual amount. And so how does that relate to the dividend payment? So if I switch actually off the annual amount for now, you'll see this is just the pure payments. This is just the reported payments. And of course, the payments were cut pretty much in half in 2022. You can see that there. But before that, they were actually increasing. You can see here the payments are slowly increasing, and then they got cut. The annual amount, though, is an easy way to think about it, because these payments can be sometimes a bit all over the place, and it's hard to add that up in your head. Well, how much is that per year? Whereas this line shows you the annualized amount of those payments, and of course, as we said, it was cut there. And so what's really powerful is then to compare the annual payment amount with the annual earnings per share. So I've just toggled the earnings per share on. Now, earnings per share, of course, can be a lot more volatile, but you can actually see how those dividend payments follow the earnings per share. And you know, for some companies, they'll be pretty much lined up because they're heavily related. So that's actually off by default, but you can toggle it on. And the last one here is, of course, the dividend yield. Now, the yield is really up and down because the yield is actually the dividend, well, it's the annual payments compared to the share price or the market cap of the company at the time. So, of course, it can be really volatile. And you know, you might get into the company at a certain point, and then you're going to have a higher yield. And so that's why this historical yield is really really can be quite volatile. And going forward, you could sort of think of that as yield on cost, because we're going to say, well, going forward, we're going to forecast that yield, assuming you bought it today, right? That's why it kind of suddenly goes flat going forward. Now, the next part I just want to touch on is this one here. This is just a good way to frame up how much the company's paying versus what else is in the market, because sometimes it's hard to know, is this a good yield? Is this normal? And it varies wildly with different markets. For example, in Australia, the companies pay generally higher yields than the companies in the US because they're doing more buybacks often. But again, the way to frame this up would be, this is what the company's paying. This is the bottom 25% of the market, so the sort of lower quartile. This is the top quartile, so this is really like the sort of top 25%. This is the average in the industry. Again, for a company like AT&T, they will be dominating this industry, so that there'll be a major factor there. And finally, that, like I said, that forecast yield, which in this case is exactly the same as the current yield. And the last part of this, of looking at dividends, is what's called payout ratio. Payout ratio is what percentage of the company's earnings, and we also do cash flow here, do the other dividend payments. And this is just a very common way to look at affordability. Can the company afford to keep doing these payments? You can see here that on an earnings basis for AT&T, you've got 63% of their earnings being paid out as a dividend, which is actually reasonably high. And then on a cash basis, you can actually see there's only 40%, which is quite a lot lower. Now, related to this, if you're interested, I'll do a separate video entirely on this topic, hopefully. But related to this, you can actually go to the past section, and you can go down and you can actually see how do cash flows and earnings compare. In fact, for AT&T, you can see that actually the earnings and the cash flows are somewhat similar, but there's a lot going on in between that. But that's a subject for a completely separate video. Now, back to the dividend section. So I've gone back to the top again. For all of the parts in this report, Simply Wall Street has 6 checks, and those checks are meant to be independent, and they're meant to all add up to looking at all these different factors. So 6 out of 6 would be this company is passing all of the dividend checks, and 0 out of 6 would be it's not passing any of them. So AT&T, you can see 3 out of 6, and I'll just quickly run through those checks because we're going to use this later when we're screening in the Snowflake. So if I go down, the first 2 things we're checking are, is it a stable dividend, right? Has it dropped at all, which it fails because we can see the dividend dropped here, and has it been growing, which of course it also fails because it hasn't been, it hasn't been growing, it's dropped. So you really want both of those, right? Now you can still actually pass the growing one with a drop, as long as the current payment is higher than what it used to be, and there's a trend of going up. That's okay. So you can still have one and not the other. But the stability as well, we can sort of handle small changes, but I think there's a threshold of more 20%. So you can't drop more than 20%. If it drops more than 20%, then it wouldn't be considered stable. The next ones are around the yield. So we're just trying to look at how competitive that yield is. The first one is actually, again, what we call notable. Like, is it a meaningful yield? I would argue that if it's not kind of notable, then you're below kind of that type 2 that I mentioned earlier. You're starting to get into type 3 type companies because it's such a small yield. It's not going to be that significant. You're almost better just thinking of this company as this is just a normal growth stock because the dividend's so small. And then of course there's the high yield, which if you are looking for that aristocrat kind of dividend powerhouse, you really would be looking for something that's paying above that, or if not, you go look elsewhere, because the idea is that there's companies out there that are clearly paying that. Down here, we're just checking those payout ratios, both compared to earnings and cash flows. So again, we're just looking for that dividend to be well covered based on those results. And that all adds up to those 6 checks. And I'll just finally add that in this section, of course, we do include buybacks. So buyback yield is also here, which is sort of like the equivalent percentage that the company's buying back shares. The buyback yield in some companies, which we'll see earlier, can be negative. What that means is the company's overall issuing shares. That's quite common. And then when we add those two together, you're going to get the total shareholder yield. So if we add those two together, we could think of that as an overall shareholder yield, but which is something I'll cover later, is buybacks are not quite the same as dividends. You're not going to get that payment in your pocket, but I think it's just really powerful, and we can screen for that as well. Let's now look at those same metrics, but let's look at a few different companies. This is AT&T, and so we saw for AT&T how the company basically sort of eroded shareholder value, which we can see here. It's really eroded shareholder value, and if you didn't have those dividends, it would be really quite underperforming investment. Ideally, with dividends, you want a bit of both. You ideally want to match the market, and you want the payments. So you can see here that this company has clearly underperformed the market, and right now, from a dividend perspective, it's looking a little mediocre. It's not really passing all those checks. It's got a 3.8% yield. It's not too bad. And one final thing though, where I think you can frame that up is, as I mentioned, you can look at the valuation. So what we can actually see here is not only is the company looking undervalued based on cash flows, right? That means that investors really don't have a lot of hope in that company. They're really the cash flow value is way higher than the share price. But more importantly, the P ratio of this company is 16. Right, and that's what I'm going to look at later. That's not a super high P. It's actually kind of low. The best way to put that into perspective would be to go here, and we can actually see, well, okay, P ratio 16. Well, there's some companies that are much higher, but we've actually got something like Verizon with an even lower P. So it's sort of a mediocre P ratio here, and you can sort of see where it sits if we zoom out. But that's important because what it means is that this is how the market is valuing their earnings. And if the earnings are valued highly, as I said, it becomes difficult for that yield to become really high because they're already valuing the earnings very highly. Let's now contrast that to a company like Verizon, which is here. So this is Verizon. I've just swapped to the next report. The first thing you can really quickly see from this report is dividend 6 out of 6. That's coming out straight away, but also the company's clearly, it's almost passing all of the value checks. So undervalued company, and therefore, of course, the dividend is getting 6 out of 6 as well, but almost 0 on growth. Very interesting, and it kind of in the middle with past and health. So not looking too hot there. So I'm going to check those same things quickly. The first place I'm going to go just below the share price chart. I'm just going to look at the shareholder returns. How has this company performed in the last few years? And oof. So you can see here Verizon. If you thought AT&T was bad, this is a lot worse, right? So you're actually down, shareholders are down 25% in the last 5 years. That's not great. Again, same market, so the market's the same. Let's include dividend returns and let's see how that compares. Okay, sorry, I shouldn't be laughing. When you account for dividends, you're almost above water, not quite, right? So when you account for dividends, you've roughly kept on hold of your money, which is better than nothing. But really, from a capital value, you're really quite down. So that's really not great. This is even worse than AT&T. You've really eroded some value here if you were coming into this company for the dividend. And just whilst I'm here, I'll just go down a little for the value section, because again, this company's looking really quite undervalued. That really tells you a lot. If the company's undervalued, why is the company undervalued? Why is the market not valuing these earnings? And even lower P ratio of 10, and we looked at that earlier. So that's something to keep in mind, right? We're really sort of looking into that value trap zone, and so this would be a type 3 company that we talked about. Coming back to the dividend section here, it's getting 6 out of 6. And this is what I tried to say a little earlier, that for these type of companies, they pass, from a dividend perspective, they can't be faulted, right? Let's look at that. So it's a great yield at 6.1%. Doesn't seem to be doing any buybacks, but it's a really good yield. Dividends growing 2.1. It's growing slowly every year. It's not particularly high growth rate for the dividend, but it is growing. And that's why the forecast yield is a little higher. That's what they're expecting. You can see here, I'm just going to remove the yield to get that picture, but it's just like, again, it's like clockwork. It's super consistent. That dividend's going up every year. The payments, there's a completely reliable payments, and it's probably going. From here we can take a look at how that yield, 6.1% compares. And as you can see, it's really up there. It's way above even the industry average. And so again, this is really a type 3 company. So it's getting both those checks here. And then finally, these payout ratios are pretty reasonable, right? It can definitely afford this dividend payment. You've got roughly 60% of earnings and 60% of cash flows being paid out. So let's now change over to another company, which would be Eni. So Eni, if you don't know, is the Italian sort of, I don't want to say state, but anyway, Italian oil and gas company. And so this is an interesting one. So let's go through those same checks again. I'm going to start off with the share price return. So like I said, just underneath the price chart. And let's start here. So we can see that over 5 years, Eni has actually returned, this is without dividends, actually returned almost 100%, right, or 95%, which is pretty good. That's without dividends. And now we're contrasting. Remember, we're in a different market now. We're looking presumably in Italy, and so that market just hasn't done particularly well in the last 5 years. So it's been fairly easy to outperform. In fact, you wouldn't be too happy, I think, with 11% over 5 years. But let's include dividends and see how it looks. So when we include dividends, what you can actually see is makes a huge difference. You're going, 95 over 5 years. Okay, that sort of not amazing. It's okay. Better than US market, but the dividends make a huge difference here. I mean, those dividend payments, getting up to 170% over 5 years. And interestingly, my hunch is that Eni is probably a large portion of that market, because the same seems to be true for the Italian market. So again, this again, I think people would be fairly happy with that. And it's not, they haven't lost out on that capital appreciation there. So go to dividends. Again, we've got that really high yield here, fairly negligible buyback. And let's have a quick look. Why is it getting 3 out of 6? So we can find out. This is always useful. You've got if the dividend payment has been announced, then you have to buy it before the ex-dividend date. So if that's interesting. Now I think this is the best. This chart tells us a lot for this company, because I'm just going to first of all switch off everything apart from the payments. And you can see here it's pretty obvious, but reasonably stable payments, not particularly growing. In fact, if we go back up here, it's almost a negligible growth rate. So this is not a growing dividend. That's something to keep in mind. But it really, you can see it's been cut here, right? So it's really not growing even afterwards. They kind of keep it the same. And so that's why, just from these payments, it's definitely not getting the check for the stable dividend, and it's not growing either. It's easier to look at the annualized amount, I think. Again, that's also pretty volatile, although increasing since 2021. And like I said, comparing that with the earnings per share. And by the way, this white line here, that's the zero crossing line. So you can see the earnings per share, but it's basically going from positive to negative to positive. And that obviously is probably one of the reasons why they've paused those payments. Now let's just quickly check the yield. Again, that yield's really up. That's definitely pretty hard to top that one. But what's interesting here is that it's not actually covered by earnings. It looks to me that there's quite a lot of volatility here. It is covered by cash flows. Next place I would go would be I'd go and look at the earnings versus the cash flows and try and see what's going on there. It's an oil and gas company. They have lots of assets. They have to depreciate, things like that. But this would certainly be worth diving into. Again, on the surface, the two look similar, right? You've got 2.3 billion versus 4 billion, but actually there's a lot going on there. Right. Let's go and do some screening. Let's head over to our screener now, and the first type of company we're going to look for those type 3s. If you remember, those type 3s are the high yielders, or the dividend aristocrats, maybe sometimes called the yield traps. So let's have a look. Now the really easy way to find a type 3 dividend company would just be to go for 6 out of 6 on the dividend score. We just saw earlier that those 6 checks, look at all those different factors, and frankly, if you're meeting all of those, that's effectively a dividend aristocrat. and it's intentionally very difficult to meet all those checks. If you look here, I've now dragged that out to be 6 out of 6, and there's only 245 companies worldwide that are meeting that. And in fact, if I go to some markets, so for example, if I go, we'll go to the US last. So let's go look at, say, Canada. So in Canada, 10 companies, right? That's not that many. Let's turn off Canada. Let's have a look at the UK. In the UK, 5 companies. And last time I checked, Australia had none. Yeah, no, there's not a single company on the ASX that's meeting those requirements. And let's go to, but there might be in the future. If you save a view, you'll get an alert. We'll talk about that in a bit. But going back to US, so US we've got 36, right? Companies meaning that. So that's a really easy way to start. But now let's go and understand the dilemma that we talked about earlier, right? With these aristocrats, you need to be so careful because so often you're giving up capital appreciation for dividends, and the easiest way to check for that would be to go in here and simply say, what did we say? U.S. market 80%. Okay, so that's they have to at least have met the U.S. market. I think it was 81. They're all gone, right? You can see that. So you see what I did there? We went 6 out of 6 for dividend companies, and in the US there's there was still 20 plus. But now all I'm asking for is for those companies to have also matched the market over the last 5 years, and now we're down to 3. So you can instantly see the point that I'm trying to make in this video, that with these high yielding companies, you are often exchanging yield for capital gain, but not always the case. So let's take a look where that might not always be the case. Now the first thing is, these checks are all quite strict. So what we can do is we can take another approach at this. I'm going to reset and click here. I'm going to reset, go back to the beginning. Let's stay in the US market for now. And so now I'm going to kind of recreate what's behind the 6 out of 6 dividend checks, but I'm going to kind of do it manually just so that we can see the sensitivity. We can see how it builds up. So the first thing I'm going to do, I'm going to simply go and ask for, I would normally use forecast yield here, just to be clear. I mentioned earlier that it's really superior, but to get a forecast yield, you need analyst coverage. So for now, I'm just going to do the regular historical yield. And let's say I'm really looking for something that has over 7%, right? We're in the type 3 companies at the moment. So I'm going to go over 7%, and I'm also going to ask for total shareholder yield to also be over 7%. Why? Because I don't want to be diluted, right? I don't want to, sure, I've literally, I can find companies that are paying 7% dividend yield, but they're diluting shareholders by 20% every year. So let's see where that lands us. Okay, so that's taking us down now to 100 companies. And by the way, I'm actually on the, I'm on the table view at the moment, but you can always swap to the tile view. The tile view, in my opinion, is much better when you don't know the companies, because I can just hover over each one and I can see what they do. It's much easier to see the snowflake. So the advantage, however, of the list view is that you get to see the dividend. So you can swap between them. Now, we can see we're 105 results, but all I've searched for is just high dividend. I haven't done anything else. It doesn't mean these dividends are affordable, right? Now let's also add that check in. Let's be a bit softer, okay? Let's not ask for 5 years. Let's ask for 3 years, okay? It's a bit softer. Let's say 3 years. Let's be kind of okay. Let's be okay. Let's say 30%. Again, we're not being too strenuous here. Again, it's the same thing. We've completely cut that down now from 100 to 12 just by asking for that. But you got to remember what I'm looking at is historical, right? It's historical. Now that doesn't mean that in going forward that these companies might not perform. They might. Who knows? Maybe the share price is already rock bottom. But you can see the point I'm getting at, which is to find these type of companies really is tricky. And you really need to be, like I said, either being completely aware that I'm swapping that capital appreciation for dividend, or
you can find ones that will pay a high dividend and will still do really well, right? But they're just harder to find, right? There really will be a gem, and the best way to make that decision, I'm going to show you later, which is narratives, because we need the company to still have some kind of value. Other things you can add here, again, we're being quite strict, so I might loosen this a little. I might, I like to keep this one, but let's just be a little looser because I want to get a nice list. Maybe I'm going to cut that down. 6% still pretty good. I can handle 6%. I probably also would want not like crazy payout ratios. So maybe between 0 and 80, like Damodaran always says, an established company will pay out 80%. So let's do 80% there. Okay, where does that leave me at? 8. Okay, so now we've got a completely new list there, because what I did is I relaxed the criteria a bit. I only wanted a 6% yield. Again, I'm kind of recreating those dividend checks myself there. And I've got a completely new list of companies that, again, I don't know these companies, but these are all high yielders, and these could all be ones that could be worth diving into. And last one, which I think is quite powerful to look at, again, is the risk scoring, right? A super risky company. So you could say, well, I don't want more than 1 or 2 risks. Let's say 2 for now. Does that make a difference? That does make a huge difference. And the real final one I would always think about is growth. Like I said, if you're going for a dividend company, you're not going for a crazy growth company. Cool, that makes sense. However, you can still ask for a little bit of growth, right? Just by dragging that snowflake again. That dilemma has appeared again. I can't have both. But you would want to sort of, that we can also go in here and we can also say, well, let's I at least want, for example, earnings to not be minus 30%. Okay, I at least want earnings to be growing 3%. Well, that doesn't sound too crazy. Again, we've lost, the dilemma has reappeared again. I guess that's the best thing about the Simply Wall Street Screener is, you can use it to explore. As I said, I'm basically trying to be completely transparent that this type 3 is a tricky one to find hidden gems, or to find something that matches that aristocrat characteristic, and it doesn't have the chance of eroding value. I do believe they're out there, just to be clear. And in fact, often some of these companies might move between the types, which I'm going to show you a bit later. So like I said, we've been through a bunch of filters there. I'll just reset, and I'll just say again, the really, really easy way to do that is just to do that. Okay, cool. I'm now looking for type 3s. And again, if I was to showcase another way to explain that type 3s, you can't have both. You have to deal with a dilemma. There we are. You can't have both. I can't have 6 out of 6 on dividends, and I can't have 6 out of 6 on future. You got to choose, right? I can start to soften these little, and maybe I'll see what I can get. Okay, cool. Now it's starting. I meant this is global, by the way, so don't get too excited. So I softened those off a bit. Now I'm getting some more results. But you see, I think I've made my point there. Next, let's take a look at those type 2 companies. Just to remind you, the type 2 are growing companies that also happen to pay a dividend. So they're growing and they're paying a portion of their profits out as a dividend. The best way, I think, to start off screening for those companies is to start actually setting your dividend yield. It's just easier because we know this is the exact range that we're going to start with. So if I actually go and set my dividend yield now for type 2, I'm going to set it to be 2% and over. It could be above 10%, but I don't think it will be. But let's just start with 2% for now. And then I'm also going to do the same thing I just did, where I'm also going to ask for the total shareholder yield to also be above 2%, because I don't want companies where I'm getting diluted. If there's buybacks, I want those buybacks to be positive. Now, if I just start with those two, you can actually see that I'm set to global here, so this is all over the world. There's a lot of companies matching that. A lot of companies paying a 2% dividend yield. And so even if I refine that down to the US, you still got almost 1,000 companies paying that. So that alone is not really that interesting. It just shows that a lot of companies are paying a dividend. But the next thing that I would add on top of that is is dividend growth. Because remember, the whole point of this type 2 company is that it's a growing company. You want to be, these companies are interesting because the companies themselves are growing, which we'll get to in a bit, but also the dividends growing. And so we're going to say we want dividend growth, right? We want some kind of growth. And for now, I'm just going to set that to 5%. We could go more, but just for the sake of this, I'll put it at 5% year on year. And so that cuts the results down a little. Beyond this now, remember, this is purely just saying the dividend's at least 2% and it's growing at 5% year on year. There's nothing else in this screen yet. The next thing I would think about adding is I would probably add a few of those dividend checks in there, because those are the checks that are looking at stability and looking at affordability, things like that. And again, it hasn't reduced it that much, but if the dividend's not affordable, that's not that interesting. So that instantly kind of takes care of that. And beyond this, though, like I said, we're looking for growth companies. We're looking for good quality businesses that are growing. So let's focus on that with the screen. And you'll notice here what I'm actually not doing is I'm not trying to look at value. Because we can see value anyway in the snowflake, and actually, if these are growth companies, they might not be undervalued. That's the whole point, right? A company that's growing usually gets a little bit more expensive. So I wouldn't put the value in the screener, at least right now. I would focus more on the quality and the growth aspect. And so the easy ways you can do that is I can just start to drag out the snowflake maybe on the past and future axes. Again, the past and future are all about future earnings and past earnings, right? So you have to have had some positive earnings growth to get here, and you have to have some forecast to get there. So that now gives us this list. Let's have a quick look at what we've got here. So it's 90 companies in the US. So we've got companies like Home Depot, we've got Cisco, we've got Merck, we've got Accenture. We've got a lot of household names here. So this alone, this is 90 companies. This is a great list to start off with, and you can go further reduce it, and there's lots of ways you can do that. The obvious one is I could ask for more growth, because again, I'm looking for growth companies. That's one approach, and you'll notice again, you'll start to hit that dilemma we saw last time, because you're not going to have a radically high growth company, generally speaking, paying a dividend. And you don't necessarily want one. You want a quality business that's growing. So other ways you could look at that, you could add risk score. That's one idea. Or any other factor. You can look at financial health as well. That might not make much difference actually. What does that do? 90 to 73. Yeah, it's not. These are all quite established companies, so you'd expect the financial health to be good. But that's a really easy way to screen for those type 2s. Like I said, you build that up, and you're looking for quality companies. You're looking for companies that are growing. But you're not looking for extremely high growth, because again, if extremely high growth and paying a dividend, that's also generally a little bit strange. Or why would they not just reinvest those earnings? Remember that when I save this view, right, if I go and click here and I go save, I will get alerts. So you can already see here we've got one new company, but I have to save it. So I'm going to call it type 2 Divi Payers. And if I save that, now I can see the one new company that's come in. Click here. That's a new company that's matching it, in the last 7 days. But we'll also email you, right? So you don't have to keep coming back and checking this the whole time. We will email you whenever that happens. So once you've found your view that works for you, just leave it, let it run, and that's awesome. So that's the type 2s. And now you're going to ask me about the type 1s, and I'm going to say in this video we're not going to screen for type 1s, because type 1s are, like I said, they're basically just regular stocks, regular growth stocks, and I don't think it's worth really screening for them because the dividend they're paying is so small. So we'll skip over type 1s for this video, and we'll do another growth video.
Now, all those things we just looked at are all the fundamental data, all of the kind of numbers behind dividend investing, but I promised that I'd give you a way to make decisions on dividend stocks that would really change the way you think. And that method is called narratives. Narratives is very simple. A narrative is a story behind a company, a story about its future, and that narrative always has a forecast and a fair value attached to it. Why this is important is that dividend companies are companies too. Like, they also have a story, they also grow, and so you really should be paying attention to that. And so the easiest way to make a decision on a dividend company is, yes, first of all, find them using the methods we just looked at, but still be thinking, what does the company's narrative look like? Like, what is their story and what's their fair value? If it's a high yielding company, you don't want that company to have a fair value that's below what you're paying, because that's almost guaranteed way to have a capital loss. Likewise, if you're going for that type 2 company where it's going to be growing, you definitely want a very strong, compelling narrative where the company can be growing into the future, and the narrative and the fair value is the best way to represent that. I've got a separate video that I'll link to in the description all about narratives, but the short version is you can either make one yourself, a narrative, it only takes 3 minutes, or you can simply follow someone from the community. So you don't even need to do all of the heavy lifting, all of the research necessarily, but you still want to follow that process. You still want to make sure that you understand the story behind that company and the fair value, and ideally there's some upside in that fair value. And then that's paired, as I said at the beginning of the video, with the fact that the company is a dividend payer, and the fact that you as the investor are choosing to take some of those profits for yourself to reinvest them in whatever you'd like to do, versus going back into the company. And that is really a much simpler way of thinking about it. Now, I mentioned at the start of this video how powerful a dividend portfolio can be when you combine it with some kind of tax efficient account. For example, in the US, that could be a Roth IRA. In the UK, that could be an ISA. In Australia, that could be a self-managed super, something like that. One thing to consider, though, is that dividends are taxed as income, not capital gains. So just keep that in mind when you're making a decision, again, about how much of your gains do you want to have in dividends. Because if you're working and you have an income, then it might make sense actually to sort of save the dividend income to later on in your career, whatever you're doing, and think about that, because otherwise it's going to be added on top of your income, and you'll frankly be taxed pretty highly. This leads us on to the subject of dividend reinvestment plans, or can be called DRIPs. Now, dividend reinvestment plans are pretty straightforward. You're just automatically reinvesting the dividends. And I think that's good, especially in general. What you'll see is one of the most powerful ways to grow your portfolio is simply to automate it. So keep that in mind, but also remember that the dividend reinvestment assumes that one company is always going to be the best place to reinvest those dividends, rather than putting it somewhere else or diversifying it. So I would say, if you're holding the company, you'd like to think it's a good one, it makes sense just to dividend reinvest, more just from the autopilot of the compounding. But keep in mind that might not be the best company, or you might want to do something else with the cash, like, for example, live off it. There are 2 types of dividend reinvestment plan. There's ones which are sort of sponsored by the company, so that it's actually to do with the company, automatically does it for you. Sometimes there's benefits there, so check it out. Sometimes you'll get some kind of small discount. Then it's almost certainly worth doing. But it can also be done via your broker, and that generally doesn't come with a discount. So, like I said, I think it's definitely worth considering. But it links back to my original point, which is, even if you're doing dividend reinvestment, you're still going to pay tax on those dividends, and that tax is depending on where you live. I'm not a tax expert, but it's going to be counted as income, not capital gains. So just keep that in mind. A question that gets asked a lot is, do dividends come out of the stock price? And the very short answer to that question is no, they don't come out of the stock price. They're 2 different things, but it is a little more nuanced than that. I'll start by explaining that, first of all, the stock price is not set by the company. The stock price is set by people trading the stock, right? And so the company can't go and say, we want to make our stock price this, although I'm sure they would love to do that. They can't. The company doesn't have control over its share price, but the company does have control over its dividend payments. The dividend payments, as I mentioned earlier, should be coming out of earnings. And so when the company usually announces earnings, it will also announce dividend payments at the same time. And so the dividend payments are entirely within the control of the company, whereas the stock price is not within control. There is also, unfortunately, no magical arbitrage that you can find with ex-dividend dates. It might seem like a cool idea to go and buy the stock just before the ex-dividend date, get the payment and then sell, but that doesn't really work. The stock prices do, adjust slightly to factor in for those dividend payments, and there's no way you can do that arbitrage, so I'll save you lots of time in trying. Now you might be asking, how do buybacks fit in? Like, what about buybacks? And obviously buybacks is something that you should be thinking about, but there's quite a big difference if you think about it between buybacks and dividends. Dividends, you're getting paid the cash no matter what, like that's going in your account. Buybacks, the company is buying those shares almost always on the open market. Like, you could sell your shares one day and the company might be the one buying them back, who knows? And so buybacks are great, but again, I wouldn't really let that necessarily change the way you're thinking about your dividend portfolio. And the buybacks is just another thing the company's choosing to invest in. So the company's saying, well, we think it's a good value to buy back shares at this price, and that's about it. You do, like we saw earlier, want to be careful that the buyback is not negative. What we could say by negative is that the company is actually diluting shareholders. That happens, and that is strange, and so that would not be worth it. So you just make sure it's not negative, but it can be a nice bonus. And again, the buyback, a lot of American companies especially using this technique to grow their earnings per share on a kind of per share basis, because they're just consistently buying back. So even if they're not growing earnings, they're growing earnings because they're simply just buying back shares. Okay, so just before I head off, I'm just going to nip downstairs and just show you what you can do after you've bought the company. So once it's in your portfolio, how can you think about monitoring it? How can you stay on top of it and make sure that it's still going to be a great quality company? So let me show you.
We've looked at how to analyze a dividend company, and we've also looked at how to screen for those two different types. Now let's look at managing a dividend portfolio. I'm going to go over to the portfolio tab here, and just to start off with, I'm going to show you how easy it is to go and import one. To do that, I just click on New Portfolio, and we're going to use a transactional portfolio here. The great thing is that we actually have an AI system where you can just drag in your files, your transaction files, and they'll automatically be uploaded and automatically processed. So you don't really have to do any of the formatting, or you don't have to go into Excel and mess around with it. It will all just do it for you. I say this is like the live demo, but yes, it should work. And this works for thousands of transactions, right? The example I'm using hasn't got too many, but you can have thousands and thousands of transactions and this will work. And it also works multi-currency. So if you've got accounts across in different locations, we'll pull that in, and we'll also put it all into one currency for you in terms of the aggregate view. So we do that as well. Okay, so that's been imported. Let's review it. Well, that looks good. So I'm going to go and save. It's called transactions, but I could change that name if I wanted to. So just to start off with, I've just imported my portfolio here, and I'm just in the holdings view. I'm just in the kind of overview. So I'll just quickly run you through a few of the things here, just so we kind of get familiar. We've got our equity curve here. We've got the total value of the portfolio. This is an important number, which is your sort of annualized return. So however long you've had the portfolio when you started transacting, we'll actually calculate that properly, which is really powerful, because you can then use that to benchmark how you're doing over the years, not just between two points in time. We've got unrealized and realized returns. That's just when you've sold a company, it becomes realized. When you haven't sold it yet, it's unrealized. And your total dividends over the life of the portfolio, which is different, of course, to what we have here, which is your estimated dividends. I mentioned earlier when we were looking at the analysis that actually using the forecast dividends where available is much more powerful, because then you've actually got the analysts saying, oh, this is where we think the payments are going to go. And that's what we're using here in the estimated dividends, is when we have forecasts, we're going to use that. And this is a much better number than you're going to see elsewhere, because everyone else just uses historical. And as you know, there's a lot of companies where it might be quite well known the dividend is going to grow, going to increase, but also there may be companies where the analysts are saying that we're quite confident that this dividend is going to be cut. So this is a really powerful number, and that's probably the best one to look at when you're looking at how much is this portfolio expected to make. You can see the holdings down here. Well, we just imported those, so we don't need to look at those. And we have our returns tab. The returns tab is where we're doing all the sort of detailed calculations behind those numbers. These are the same breakdown that I just showed you. And if you go down, you'll see that you got obviously every stock here and the summary for each stock. But I can then actually go and click on one of these, and I can see all of the dividend payments that will show up here. And not only that, if there's any stock splits, they'll show up there as well. Let's go to the dividends tab next. I think that's the big one. So this number in the dividends tab here, this is the same number that I just mentioned. This is the kind of forecasted one. Now we here are forecasting for the next 12 months, like sort of imminently what can be expected. But actually in this tab, we're going out even further than that. You'll notice we're actually going up to 3 years. And that's because I mentioned that actually the analysts generally do forecast out to 3 years. And even if there's no analysts, we've got the trajectory of the growth. We know the dividend growth, so we can even use that if the analysts haven't given any forecast. So we can actually kind of forecast pretty well where those dividend payments might end up. And the coloring here is very simple. It's basically based on the snowflake. So anything that's getting more than 4 out of 6 is going green. Anything in the middle is going to be orange, and then anything which is scoring really badly is going to be, less than 2 is going to be red. Well, there's no red ones in this portfolio, but just as an example, it makes it really easy to see how your dividends are going to grow, but also what's the quality of those dividends. And if something changes, it will show up as red here. And not only that, we'll see in a second, you can go into your updates tab and see when you'll get an update when something's changing, but we'll cover that in a moment. This is the actual payments. So what we're looking at so far is annualized. It's looking over the entire year. But in terms of actual payments, what we're doing here is actually we have this is like a teal color, which is when the payment is declared. The company has actually said, we are going to pay this dividend. And then we've got the pink color, which is where it's been estimated. Estimated usually is something that we will do based on the prior payments from the company and also the forecast, as I said. So this is the same data that's going into the number above, but just with much more detail. And so you can see here that you can go month on month. I can click on any of these and I can see in that given month what are the estimated payments, and when those are being declared, they'll show up as declared. So this is just really great if you really want to get granular into what am I actually going to get paid in which month. And the last one I'll just point out here, which is useful for some people, yield on cost. We talked about yield on cost earlier, and it's a really useful metric. The reason the yield on cost on this portfolio is so high is because this portfolio has done well, and some of the companies in this portfolio were bought a very long time ago. And so of course the yield on cost is high. That's what we already went through. So the next one I want to show you is the updates tab, which is over here. And the updates tab is where we're going to capture anything that's changing with any of the stocks in your portfolio. You can come back to this tab and check on it whenever you want, but we will also send you an email alert when one of these that's important has happened, so you'll get that straight away. And if you have our mobile app, you'll get a push notification. But as a dividend investor, the one that's probably going to be most interesting to me is the dividends section. And these are the normal announcements that you're going to get, but we're just going to give you a feed, and this is the dividend may have been confirmed, increased, decreased, anything like that. It's going to be in here. Other ones that are also pretty interesting though for dividend investors would be, of course, your earnings updates, but even new risks to the company will show up here. So anything on those risk checks that I showed earlier, they'll show up here and you get that alert. So this is a really powerful section just to see what's happening. And we'll touch on narratives at the end, but when narratives are being updated or there's any new narratives on the companies that you own, you'll see them here. The last tab I want to show you is the analysis one, and we'll go from analysis. There's a lot in here, so we're not going to go into every item, but we're going to go to the dividends part, just because I think that this is actually this is really interesting. First of all, we looked at the estimated yield of the portfolio, and there's a lot of calculations going into the estimated yield. But if you just want to see the current yield of the portfolio and how that's doing, you can do that. You can, that's a funny thing, but you can do that here. So you can see that actually this portfolio is only yielding 3.1%, which is actually means it's mostly being made up of those type 2 companies. It's not a 7-8% yielding portfolio. And this here is the aggregate, so the sort of weighted average of the dividend growth rate. So every dividend company in your portfolio, we're going to weight the growth rate, which we looked at earlier when we were screening, and we're going to show how is your portfolio growing compared to the market. And here's what's interesting is we're also looking at the US market, or whichever market you're in, average. So you can actually see, are your companies growing dividends at the same rate as everyone else? And it's actually powerful because you can even see with this portfolio, it's actually not quite meeting the average, which would imply there's other companies out there that are growing even faster. And I showed you earlier how to go and screen for that. Lastly, of course, you've got payout ratio. This again is the weighted average payout ratio for your portfolio. So you can just see overall how much of your earnings are being paid out as a dividend. And the last tab I'm going to show you is narratives. Narratives is just such a powerful way to make decisions on any stock. It doesn't have to be dividends or growth stock, but narratives is such a great way to make those decisions. And with the dividend stock, as I mentioned, it really should still be part of your process. It would be very dangerous just to be buying a company, completely ignoring whether this company actually has some kind of story, something that's going to keep it either alive or hopefully even better than alive, growing into the future. And narratives is the best way to do that. So I've just imported this portfolio, and so the narratives that you're seeing here are just sort of the default ones that have been selected, and often we'll select the narratives that we create based on the analysts that cover the company. But you can go in and override that and choose your own one. So I could go into here and I could go select, and I can see that I can actually choose between the one here, which is from the analysts, but I can also choose, I could use a discounted cash flow value, or I could choose one from one of our users. And once I set that, that's going to set my fair value. So let's, for example, let's for some reason, if you were setting this one, it will be strange because it will be below the value that you own. But once I set that fair value, I've now assigned that to the stock, and that's what I'm going to track. So, you know, like I said, when you're looking at these companies, ideally you really would expect that the fair value is at least above the price, because that's at least, like I said, you at least want those companies to have some upside. Even if you're going for type 3 companies, you still want there to be at least some upside in the fair value. Otherwise, it's almost certainly going to erode some of that capital value. And so that's the best way to do it. And like I said, once you choose those narratives, we're going to keep you up to date. You can see here whenever the narrative changes, we'll let you know, and we'll let you know why it's changed. So it's a really kind of game-changing way to manage a portfolio.
So I hope you enjoyed that video. Hopefully it was the right level of detail and you've learned a lot about dividend investing. I would love if you can just post any feedback, any ideas, anything you think I've missed, or any questions you have in the comments, and any other videos you'd like me to produce. I'm sorry that we didn't get to go sailing on this trip. The wind didn't play ball. It was a very calm day today, but I promise on the next video we'll try to go sailing together.